0.4%. One gender, male or female, over a 10-year period of investment returns outperformed the other by 0.4%. Can you all guess whose portfolios did the best, male or female? And you can just come off mute and say it.
Male.
Female.
Okay, tiebreaker here. It's women. We outperformed men in a 2021 analysis of 5 million Fidelity customers over a 10-year period. But do all women have the confidence of Beyonce when it comes to investing? Well, we don't. And I want to share some other recent studies to drive this point home. So if you'll take a look at the slide, this slide with the graph comparing investing confidence by gender, 71% of men self-identify as having a high level of investing knowledge compared to just 54% of women. And 49% of men say they make investment decisions compared to just 34% of women. Now, just a third of women consider themselves investors, according to Fidelity. And possibly because of our lower confidence levels, women are more likely to seek help from a financial advisor. A 2021 study by showed that half of women work with a financial advisor, whereas just 37% of men do. So today I want to teach you fundamentals that will prepare you to leave here ready to invest confidently. We're going to unpack the what and how of investing basics. So if you have any questions, I'll ask you to please put them in the chat. And at the end of the presentation, hopefully we'll have time for a little Q&A. So started with the why in the form of a cautionary tale. Once upon a time, there were two young women starting their careers. Claire was ambitious and smart. Right out of college, she started investing a portion of her paycheck for retirement. It wasn't much at first, but she was consistent. Now, over the years, she added to investments whenever she could. She took advantage of her employer's retirement plan, and she advocated for pay raises. She researched stocks, diversified her portfolio, and even sought advice from financial experts. Over the years, Claire's investments grew steadily, and by the time she reached her 50s, she had accumulated a sizable nest egg. She was able to retire comfortably in her 60s, travel around the world with her husband, Cliff, and spoil her granddaughter. Claire was living the dream, enjoying the fruits of her early financial discipline. On the other hand, there was Dorothy. Dorothy started her career at the same time. However, she never really thought about investing. She enjoyed spending her modest income on nice pajamas, cheesecake with her friends, and indulging in trips to the Bahamas. Dorothy lived for the moment without much thought about tomorrow. Years passed quickly, and Dorothy found herself in her 60s still working full-time. She hadn't advanced much in her career because she hadn't invested in pursuing higher degrees. As retirement age approached, Dorothy realized she didn't want to rely solely on Social Security, and it wouldn't be enough to maintain her lifestyle. She had very little saved up, and retirement felt really scary. So if you identify more as Dorothy, please take this information to heart and take action as soon as possible. There are many reasons why you can and should invest. Your goals will inform your reasons for investing. But just about everyone wants to retire and not depend on income, because that's the dream, right? I wish that every woman would think of investing as self-care for you, but for you in the future. So if you would indulge me for just a minute, I'd like for everyone to close their eyes if you're not driving and that's available to you, so you can visualize a future retired you. What are you doing? Where are you in the world? What do you look like? And what are you wearing? Are you healthy? And who, if anyone, is with you? So I'm going to end for just a few moments to let you relax and daydream. Now you can open your eyes. I'm going to cut you off there before you fall asleep. So, would anyone like to come off mute and share what they visualized with us?
Sure, I will. I kind of felt like I was at the spa and about to get a massage. So it's really lovely.
So, I didn't want you to
Um,
fall asleep.
I know. I visualize the people I'm with, my husband, and ability to go visit grandkids and kids. I visualize being healthy and spending lots of time doing fun things, being in the garden, hiking, traveling, being with friends.
Great. Thank you for sharing. And as we think about that, what are some of the things that are going to require retirement income to be able to do that? You mentioned things like traveling, spending time with people. I'm sure that you'll want to do fun activities. So, just things to think about when we think about treating ourselves later in life, and what we need to do now to get to that point. Annie, did you want to share or did you want me to move on?
When it, well, there's special days and everyday days, and I always have this vision of myself uh, sitting on a balcony in Copenhagen, drinking coffee in the morning, and then going for walks and doing whatever I feel like. This sort of a
Yeah, well,
special
that's
thing.
that's great. And you don't want to have to be worrying about money or working at that point, right?
Yeah.
Oh, sorry, y'all. I tried to move you and I moved you right into the presentation. So let me get you moved out of the way. Continue. Okay. And Annie mentioned, sorry, not Annie, Andy mentioned in the chat she wanted to be traveling to places she wants to learn about and hang out with her grandkids. And we all know how expensive travel can be. So thank you all for sharing, and we're going to move on. So let me ask you another question. What do you think is the secret ingredient to investing? You can come off mute and just guess.
Start early and be consistent.
I would say that is correct. That was two things.
Sorry.
No, that's okay. That's fine because they're both correct. So think of time in the market as the secret ingredient to investing, which you mentioned. And I like to think of compound growth as the secret sauce. So let's first talk about time in the market. Understanding and leveraging time in the market can make a huge difference in achieving long term financial goals. The time in the market refers to the concepts of staying invested for 10 plus years and allowing your investments to benefit from compound growth. Like I said, time market, secret ingredient, and the secret sauce is the compound interest. It allows your money to grow exponentially over time with your earnings reinvested to generate even more earnings. The longer you stay invested, the more powerful this compound effect becomes. So, why can't we just stick money in a high interest savings account or under our mattress mindlessly and achieve the same results as investing? And that's because of the evil inflation monster. Inflation erodes the purchasing power of money over time. For example, $10 today might buy us a penny size Starbucks coffee, but only a tall size in the future because of rising prices. Investments aim to generate returns that exceed the rate of inflation, ensuring that our money retains its value while also growing over time. Now, let's talk a little bit about our basic portfolio building blocks, and those are stocks. Before you invest in a stock, you should be able to articulate what a stock is. So here's how I explain it to my kids. If a company is a pizza, then a stock is a slice of a pizza. So maybe a lot of people like this pizza because it's great and they want to buy a piece. So that pizza has to get cut into even smaller pieces. And also the price goes up because that brand of pizza is really popular and in high demand. Now, evaluating individual stocks can be a whole presentation on its own. So I'm just going to show you how to press the easy button on investing in stocks so you can just get yourself started. So say you're ready to invest. Now, what do you invest in? That's the $64,000 question, and it's our second agenda item. And because I'm not a financial advisor, I can't actually answer that one for you, but I can give you some ideas. Now, can anyone fill in the blank on this statement? You need to what your portfolio? You can come off mute. I bet you know the answer.
Diversify.
Diversify, she says enthusiastically. Ding, ding, ding. Andy gets a prize. But what does a diversified portfolio actually look like? A very basic diversified portfolio consists of three asset classes: US stocks, international stocks, and bonds. So want to push the easy button on diversifying as well? Enter mutual funds and ETFs. Now, mutual funds pull money from multiple investors to buy a diversified portfolio of stocks and bonds, and it's managed by professionals. And ETFs, which stands for exchange traded funds, also offer that diversification but trade like stocks on an exchange, allowing for real-time buying and selling. Both options provide a simple way to invest in a variety of assets, but they differ in trading flexibility and management style. And I just want to show you a snapshot of an ETF, and the ticker symbol you'll see is VOO, because I wanted to talk about expense ratios. And you'll see that I've circled this expense ratio in the bottom right hand of the slide. And it's 0.03%, which is a low fee. And you can also use this information to evaluate the performance of a stock. Now, a good range for expenses is to stay at or below 0.2%, but you definitely want to stay under 1%. And you might find that mutual funds will have higher fees because they include management fees and other shareholder fees like sales loads and redemption fees. Mutual funds can also trigger taxable events even when you don't sell any shares. So something to keep in mind. And our last asset class is bonds. Now, bonds are debt instruments and that you are lending money to the bond issuer. The issuer, which can be a company or a government, agrees to pay you, the bondholder, back your principal plus your interest at a certain point in time. Now, I bet bonds are boring, and they are boring for a reason. If stocks are the Lamborghini of your portfolio, then bonds are the Toyota Prius. And I'm sorry, that's not a dig. If you own a Toyota Prius, I don't think you're boring. But a Prius is sensible, it's less risky, like a bond. It's a hybrid of what stocks and cash can return. They can keep your portfolio stable during times of high volatility in the stock market because stocks and bonds have a low correlation. Correlation is just the degree to which two securities move in relation to each other. And I have a graph to demonstrate. You'll see the price movement of Treasury bonds in red and the S&P 500 in blue. And you'll see that they're generally moving away from each other. except in like weird economic times where you'll see the lines cross or even invert. And that's something we've seen recently. Now, government bonds are also exempt from some, but not all income tax. So here's another way to push the easy button for you. And we're going to visualize a dinner party, use that as an analogy. And we're going to serve up, instead of pot roast and red wine, we're going to serve up index funds and target date funds. So just like our pot roast recipe, we're going to use a mix of staple ingredients. Like index funds use a mix of variety and stocks to represent a whole market. An index fund is a mutual fund or ETF that tracks with a financial market index. Now, has anyone heard of any of these markets I'm referring to? You can come off mute and answer any that you know.
The S&P, Dow Jones.
Good. Any others you might have heard of? What about an index for tech stocks you might have heard of? Does the NASDAQ ring a bell?
It's like, I know there's another main one. What is it called? I'm blanking.
I know.
Yeah.
These are not things that we're thinking about all day, every day, if we're not financial advisors. You might have also heard of the Russell 2000, which is just a small cap fund. And that's a small cap is just like it sounds, a smaller company. So like cooking yourself to save money over hiring a caterer for our dinner party, index funds typically have lower fees compared to actively managed funds. We also have another easy button when it comes to retirement and education and investing, and those are target date funds. Now, target date funds are like a fine wine that matures over time, and they have a date, which is the goal when you hope to achieve things like retirement or paying for education. And at that time, they are heavier in stocks than bonds. But as you near your retirement date, they gradually shift to a smoother, more balanced blend with less stocks and more bonds. This automatic adjustment helps to protect your investment while still aiming for growth. And that's just a fun meme I had to throw in there. Well, I want you to gain confidence from this presentation. I also don't want you to be overconfident. You might hear of advanced investing techniques once you get started. Now, researching them is great. Please do it and do it often. But be cautious of things like derivatives, swaps, day trading, trading on margin, and cryptocurrency, just to name a few. These are all legitimate investment products. You need to have at least a basic understanding of how these work, and certainly the risk involved and tax consequences. So we come to our final question of investing. Discount brokerage. These are all highly rated firms. Preference, which is similar to insurance, that if the firm should fall for any reason, a certain portion of your account would be protected. You can also ask family and friends who they prefer. You can get on their websites to see which one is most user-friendly to you. And you'll notice they have different minimums to get started. And Charles Schwab is the most affordable. You can start with $0. So if you're saving for retirement, you'll need to open an IRA account, which stands for Individual Retirement Account. And there are financial firms, or you can ask your accountant or your financial coach to help you figure out which one is the right one for you, and also the income limits for each type. If you're saving for a nest egg or a business or your wealth, on the other hand, you can open a brokerage account. These are not tax sheltered like retirement accounts, and you'll be responsible for dividend income tax annually and capital gains tax when you sell your invested assets. Is anyone already using one of these firms that they think that they would recommend to a friend? You can come off mute and say if you have one you prefer.
Schwab and Fidelity.
You use both? I think they're both great.
Yeah, we use for retirement accounts, they're already in Fidelity, and then our financial advisor uses Schwab.
Okay, great. I think Fidelity is especially great at providing education to the clients. You can research just about any topic, and they'll have an article or a webinar or a video to help you out. Thanks for sharing, Kathy.
I use Schwab, and my mom has Vanguard, so I help her with that as well.
Yeah.
But I
Both
love
are great.
Ellevest as a company. I love everything about it.
Right.
There are fees, but maybe
Mhm.
that's right for people who want a little bit more support in that environment.
Right. And they do market more towards the female investor, which I think is great. And they have an interesting price model that I won't go into now, but it's definitely worth looking into. So once you open your account, you can link a bank account, deposit your money, and buy your assets. Now, this seems really obvious to a lot of people, but it is really important. So I'm going to say it again. You have to put money into your account and then buy investment products like those bonds, ETFs, and mutual funds we talked about. It's not the same as just opening a savings account and depositing cash into it. So I've had a client that I was helping open an account, deposit the money, and forget to buy their assets and have money sitting there earning pretty much nothing. And that's exactly what you don't want to do. So if you're still not feeling confident enough to build your portfolio, that's okay because there are other options for you. You can choose to use a robo-advisor to build your financial portfolio based on your goals, your timeline, and your risk tolerance. The account fees are pretty low. They're typically 0.25 to 0.5% of your invested assets, and it's easy to set up and maintain. The next level up from hiring a robo-advisor is hiring a financial advisor. And hiring a financial advisor who is experienced has the benefit of those one-on-one consultations with planning and fees generally costing you 1% of assets under management, or they can be paid as a one-time project fee if you hired a fee-only advisor. Now, please remember that 1% of assets under management doesn't sound like much at all, but as your assets grow, so does the amount that you're paying. And that fee over decades can cut substantially into the growth of your portfolio. But I'd still rather you hire a financial advisor than not start investing at all. So, ladies, there's 3 points I want you to remember from this chat. Number 1 is start now. And by now, I mean today if you're not already investing. Because time, remember, is the most powerful multiplier when you're investing. Number 2, avoid fees. If you only looked at one aspect of a mutual fund or ETF, besides performance, of course, check the fees. And number 3, stay for the long haul. Investing is a marathon and not a sprint. We're not day traders here, and we're not trying to time the market. It's going to go up and it's going to come down, and we're going to keep calm and we're going to hang on for the ride. So please believe that you can do this. And thank you so much for your time. And I'm happy to answer any other questions that you have. You can come off mute or put them in the chat. And if you'd like to contact me for any additional help, you can do so by scanning the QR code on your screen.